Well, we certainly have a near-term squeeze. You can, given the spreads that the industry has historically enjoyed, you can afford a 3.5. You can afford a 3.5 or 4% lease rate. Not a problem.
Hmm.
A 35% lease rate,
Hmm.
that's catastrophic. The margin. I think the lease rates that you quote, 35% for the near month and 9, 10, 11% further out, talk a lot about the market's belief that, as you had suggested earlier, there is silver out of system that can, over time, come into the system.
Rickrule, a veteran investor and former president of Sprott U.S. Holdings, has long been regarded as one of the most respected voices in the natural resource and precious metals markets. In his latest analysis, Rule emphasizes that both gold and silver remain in the early stages of a multi-year bull market, driven by deep structural imbalances in the global financial system. He points out that despite recent price volatility, the fundamental forces supporting precious metals have never been stronger. Massive government deficits, record debt levels, and chronic inflation are eroding confidence in fiat currencies, while central banks continue to accumulate gold at the fastest pace in decades. According to Rule, this represents a powerful shift in global capital flows, a move away from paper promises toward real, tangible assets. Rule's outlook on gold is grounded in long-term macroeconomic realities rather than short-term speculation. He argues that gold's strength stems from its role as a store of value, immune to counterparty risk and political manipulation. While mainstream investors still underestimate the risks embedded in sovereign debt and fiat currency systems, Rule sees a growing awareness among institutional players who are quietly increasing their allocations to gold. He believes this trend will accelerate as inflation persists above official targets and real interest rates remain negative. In his view, gold's rise is not simply a reaction to monetary instability, but a reassertion of its historical role as the foundation of financial trust. Like, subscribe, and stay prepared for more real market insights is the truth. They won't tell you on mainstream finance is what could protect your wealth tomorrow.
Silver's emotional,
Hmm.
and the stupidity of small groups of people is basically boundless.
Hmm.
I don't have a number on it, but my experience has been in prior bull markets that from the point in time when silver begins to outpace gold, that its rate of escalation is at least double that of gold. With regards to gold, and I'm sorry about the elliptical way I answer the question, but with regards to gold, I believe that if the purchasing power of the US dollar declines by 75% over 10 years, which I think it will, that the nominal US dollar price of gold will likely mirror the deterioration in the purchasing power of the US dollar. So a 10-year threefold increase in the gold price wouldn't surprise me at all. If past is prologue, the silver price escalation could double the gold price escalation. Will it? I don't know.
So you're
And you
talking
know,
about a 4-bagger
Trey,
with gold and an 8-bagger potentially with silver,
yeah,
correct?
yeah. And I really don't care.
Hmm.
I'm going to own some silver because I believe that gold is in a primary bull market, and my history tells me that silver will outpace it. I regard my gold personally as savings. I regard it as something that maintains my purchasing power. I have benefited so extraordinarily as a speculator with silver in the past that I'm going to continue to hold some silver purely for greed purposes in the last silver squeeze. And at that point in time, North America was short of silver. And you may recall at Sprott that the Sprott Physical Silver Trust was growing
Hmm.
ridiculously. And they cleaned out the silver in Toronto, then they cleaned out the silver in Ottawa, then they cleaned out the silver in Chicago, then they cleaned out the silver in New York, and they had to bring silver from London. Now we have a situation where London's out of silver, and so they got to clean out New York. But the other point you make is that there's a whole bunch of silver that isn't good delivery COMEX or good delivery LBMA silver, but it'll find its way in the system over
Hmm.
time.
Right.
And by the way, if the silver price was to fall back from whatever it is today, 50 and change to 40, it wouldn't derail a precious metals bull market. It would change a whole bunch of people that got the religion of silver in the last 4 weeks
Hmm.
and make them doubters. But that doesn't matter.
Right.
I mean, it'll matter to them if they get whipsawed, but it doesn't matter. The fact that silver went from 40 to 50 is only validation of the thesis for those people who needed validation. And were silver to decline from 50 to 40, that wouldn't matter much either, except for the people who were trading that move on margin. Well, we certainly have a near-term squeeze. You can, given the spreads that the industry has historically enjoyed, you can afford a 3.5. You can afford a 3.5 or 4% lease rate. Not a problem. A 35% lease rate. That's catastrophic. As you know, many of the traders are running 10 or 15% equity to assets. That does more than eliminates the margin. I think the lease rates that you quote, 35% for the near month and 9, 10, 11% further out, talk a lot about the market's belief that, as you had suggested earlier, there is silver out of system that can, over time, come into the system. I remember conversations that you and I had 2 decades ago where we both sort of chuckled and said, over time, markets work. The cure for high prices is high prices. The cure for low prices is low prices. And that really, ultimately, price in the very long term is a function of utility. In the very near term, these high prices might be problematic for traders. That's what the lease rate suggests. In the long term, you have to look at the utility of precious metals for savers relative to the utility of the U.S. 10-year Treasury. that one makes me long-term bullish.
When it comes to silver, Rickrule takes a slightly different tone, one of both opportunity and volatility. He often describes silver as gold on steroids, noting that its smaller market size and dual industrial monetary nature make it far more explosive during bull phases. Silver, he argues, tends to lag gold at the beginning of a precious metals cycle, but dramatically outperforms once investor sentiment turns euphoric. As industrial demand from solar energy, electronics, and electric vehicles continues to rise, silver's physical supply deficit grows more pronounced. Rule points out that many silver producers have been underinvested for years, leaving little room for production expansion when demand spikes. This supply-demand imbalance could set the stage for a powerful breakout in silver prices once momentum shifts decisively upward. Rule also highlights the leverage offered by mining stocks, particularly junior and mid-tier producers. He explains that well-managed miners can deliver exponential returns relative to the underlying metals, thanks to fixed operating costs and profit margins that expand rapidly as prices rise. However, Rule cautions that this leverage works both ways. Poor management, political risk, or operational setbacks can quickly erode investor returns. He stresses the importance of due diligence, suggesting that investors focus on companies with strong balance sheets, quality assets, and experienced management teams. In his experience, disciplined stock selection in the resource sector can turn cyclical opportunities into generational wealth.
I suspect that pressures were building against fiat-denominated savings products, U.S. Treasuries and things like that, for years. They were building, but because they were performing, the products held up well. When those products, being fiat-denominated savings products, 10-year Treasuries as an example, faltered, they faltered in spades. And they gave up what I might consider long of tooth gains. So I think that, Trey, we're experiencing in 2024 and 2025 pent-up fundamentals that go back at least 7 or 8 years, but particularly go back to 1999. I would also ask your listeners to consider the longer-term performance of gold, going back to, say, the year 2000. I remember answering many interviews a few years ago when people say, well, when is gold going to move? I would say, well, I think it's going to move in the year 2000. At that point, it was up 7% compounded for 20 years. Now it's up 9% compounded for 20 years. What it's done in the last year gets the headlines, but what it's done for 25 years should get people's attention, a fairly long time. The U.S. on-balance sheet liabilities relative to GDP 40 years ago were 30%. Now they're at 120%. The 2008 circumstance was correctable with quantitative easing, which you and I would call counterfeiting. But increasingly, my suspicion is that the powers that be will be pushing on a string. The other thing, well, I think there's 2 more things that make this different. The first is the incredible sum of the net present value of unfunded entitlement liabilities, the off-balance sheet liabilities of the U.S. government, the promises that they've made to old geezers like me. That number, according to the Congressional Budget Office, exceeds $120 trillion. To put that in perspective, the gross federal income is $5 trillion. That's a fairly ugly mismatch. The second thing that's different now, Trey, I think, is the dawning realization that United States savers are experiencing negative real interest rates. If you follow the theory that gold does well when people are concerned about the maintenance of purchasing power in the US dollar, if you believe in the CPI, which neither you nor I believe in, the government would suggest that your dollar is declining in purchasing power by 2.9% compounded. But they buy their groceries, their goods and services, in hedonistically adjusted grocery stores, which are not available to us. I would suggest that the purchasing power of your savings and mine is declining at about 8% compounded. And the arithmetic problem there is if you're saving at fiat denominated instruments, let's say the US 10-year Treasury, the world's benchmark security, you're getting 4.6, paid 4.6, pardon me, in a currency that's declining at 8. That means you aren't making 4.6. You're losing 3.4 every year for 10 years. There can't be a circumstance in the long term that is better for gold than that. You and I are going to get a lot of hate for this, Trey, but you're absolutely right. What matters in a silver bull market, in my experience, the three that I've lived through in my lifetime, is investment demand. The delta between buyers and sellers in the investment market.
That's the end of it. It's that simple.
Yeah, I mean, I've been aware of the arguments around the physical utility of silver for a very long time. I remember when photographic demand went away, and I remember in the middle of photographic demand going away, one of the damnedest spikes I've ever seen in the silver market.
Mm-hmm.
It was really difficult for me to explain that away in any other way than observing the fact that in the investment market there was a lot more buyers than sellers.
Mm-hmm.
And I understand the implications of increasing photovoltaic demand. I understand the incredible implications of silver's efficacy as a water treatment item or a anti-germicide. I get all that, and I think it's important. But it would appear to me that what generates real price moves is simply the imbalance between buyers and sellers. I think maybe the second thing that makes judging silver pricing as a function of industrial demand difficult is the fact that on the supply side, most silver doesn't come out of silver mines. It comes from recycling or it comes from a byproduct of other metals. So you have this weird thing with silver that when the silver price goes up, it doesn't necessarily stimulate supply. An increasing copper price or zinc price or lead price might stimulate supply, but an increasing silver price doesn't seem to do that. It might encourage more recycling, but it's a very, very odd metal.
Over the coming years, gold and silver are expected to enter one of the most powerful and transformative bull markets in modern financial history. The global economy stands on the brink of a structural reset, driven by unsustainable sovereign debt, persistent inflation, and the weakening credibility of fiat currencies. As confidence in paper-based systems erodes, capital will inevitably flow toward tangible assets that preserve value. Precious metals are poised to be at the center of this shift, serving not only as safe haven assets, but as the foundation of a new financial reality, where real wealth is measured in ounces, not in paper currency. Gold is likely to take the lead as monetary instability intensifies, breaking through all previous highs and reasserting its role as the ultimate store of value. However, silver is positioned to outperform gold in percentage terms, fueled by its dual identity as both a monetary and industrial metal. The growing demand from sectors such as renewable energy, electric vehicles, and electronics will tighten an already strained physical market. Once the imbalance between paper-silver contracts and real-world availability becomes undeniable, a violent repricing could occur, propelling silver into levels that were once considered unimaginable. Like, share, and subscribe for more hard truths about the endgame taking shape in real time.